Welcome back to Squawk Box. Let's check the futures right now. Not a lot happening. A little bit of red across the board. Join us now with more on the markets. Bill Nygren, Oakmark Fund's portfolio manager. Sorry, I'm a creature of habit. I cannot intro you without mentioning that you were talking to Mark Haynes when the first plane hit.
That's right. I was in the studio in Chicago. Talking about cable TV stocks or something like that.
And I said, how long did they say, just, we'll be back to you, hold on. It was
about half an hour.
A half an hour. He said, wait, we might come back to you. And then it wasn't a half hour, it was about 3 years when it was all said and done. Just in hindsight, what did you tell, because you were usually long, you're usually fully invested. What did you tell investors back then? Do you remember? Were you happy with the advice that you were given? We recovered fairly quickly, did we not? How long did it take?
Yeah, it didn't take that long. Since Oakmark started in 1991, our advice is always think about what a company might be worth 7 years from now and try and buy it at a very significant discount to that today. And the events that you think about that have happened since 1991 that investors have gotten worried about and wondered, like, is this the time to be out of the market? They've all paled in comparison to the economic growth we've seen over those next 7 years.
And that included September 11th and a pandemic.
We started Oakmark in 91.
What's after that? The end of the world is the only thing after that, isn't it? And like Markesh said, the trades won't settle anyway. So,
but if you put $10,000 into the S&P when we started Oakmark, you have about $250,000 today.
What about maybe tariffs? Maybe from what I see, a lot of people in mainstream media saying the tariffs are worse than the pandemic and September 11th.
Something we've always said is that economic forces are stronger and longer lasting than political forces. And the reasons are that there's so many checks and balances. It's really difficult to have stupid policy in place for a very long time.
That's amazing, isn't it? And those guys thought that up like a couple hundred years ago on how to structure things.
What's so fascinating, we're talking about the Israeli stock market right now. You have missiles landing literally next to the exchange, and it's up.
Think about who was on last week? It wasn't last week, it was on earlier this week. The picture of the Middle East and the world, if you take out this pain in the ass that we've had since 1979, and suddenly the Abraham Accords, people start talking to Israel, suddenly I don't know, maybe that's idyllic and it never really happens, but you could make a case that this could be very positive for the world if
it all works out.
Yeah, exactly. And you think you're not a geopolitical
It's not something we spend a lot of time thinking about.
But tariffs you thought about? You didn't?
Well, sure, we thought about tariffs, and we tried to make an estimate of how much business values would change 7 years from now based on tariffs.
Yeah.
Our conclusion was they would probably modestly hurt the intermediate term cash flows. But the stock market reaction, if you remember, Liberation Day, we had 3 down 5% days in a row. And we had a very hard time estimating that the average company had lost 15% of its value. So to us, it was an even better opportunity to invest.
You point out, I think rightly so, that the 22 times earnings for the S&P, that's only a few stocks gets it there. Most of the stocks are not at 22 times.
Yeah, the spread in the market today is unbelievably wide. If you take the top 100 PEs in the S&P 500, it's a little over 40 times, but the bottom 100 are at about 12 times or under. And what we do at Oakmark is try to identify the companies that are out of favor, selling at a significant discount to value.
And you got a couple of examples, First Citizens and Airbnb.
Yeah, most of our portfolio is more traditional value stocks, the single-digit PE companies like Citigroup and General Motors. But we also try to invest at what I would call the intersection of growth and value. There are a lot of investors that think of growth and value as opposites. And we think value is the opposite of expensive and growth is the opposite of no growth. Usually high growth companies bring high prices, but sometimes they don't. A company like First Citizens, and they're about the 15th largest bank in the U.S. They were the ones who bought Silicon Valley Bank from the FDIC. Over the past 5 years, they've more than tripled earnings, more than tripled book value. and the stock sells at less than 10 times estimated 10 times estimated earnings for next year, and under adjusted book value for the end of next year. And you look at something like Airbnb, and GAAP accounting makes them take all of their long-term investment spending right through the income statement. It looks like the stock's selling at 30 to 40 times earnings today, but if they have the same take rate that Booking.com has, and we think Airbnb probably has more leverage with their providers, it would sell at a below market multiple.
Okay, great.
They're also spending a lot of money trying to get experiences, so their R&D expense is very high. If they brought that down to an industry average level, it would be below a market multiple, and it's a great growth business.
Great. It was Steve Eisman, who you know.
Right.
I mean, he's worried about near-term tariffs, near-term, the conflict, but things work out. Anyway, Bill Nygren, thanks.